So the World Gold Council released new data today on Thursday, August 1st, 2019, and the data is good if you like gold. So let me just talk about it really quick. There is a Financial Times article about it. I'll put a link in the information section if you want to check it out more, but combined with the other gold stories I've been covering over the last couple weeks, whether that's the European gold agreement ending, the 20-year-old gold to sell gold that ended. On top of that, Ray Dalio basically seems even more bullish on gold than he was in the past, and it sounds like he's recommending an increase in gold holdings from his 7.5% or 10% normal all-weather gold portfolio up to higher. He basically wrote, sell stocks, buy gold. So central banks purchased, back to the article, central banks purchased a record $15.7 billion worth of gold in the first 6 months of the year in an effort to diversify their reserves away from the US dollar as global trade tensions continue to simmer. So institutions are diversifying reserves away from dollar in the first half due to trade wars and currency wars. Data released by the World Gold Council on Thursday showed central banks, led by Poland, China, and Russia, bought 374 tons of gold, the largest acquisition of the precious metal on record. So the largest acquisition of the precious metal on record, not in the last couple of years, on record, by public institutions in the first half of a year. So this was a record-setting 6 months for gold purchases by central banks. Central banks accounted for nearly 1/6 of total demand in the period. The pattern advances on last year's activity in which central banks hoovered up more gold than at any time since the end of the gold standard, where a country could link the value of its currency to the precious metal. Okay, so they have in parenthesis explaining what a gold standard is, because I guess most people don't even know or remember. They have explaining what a gold standard is in parenthesis in 1971 in this article. The shift in attitude towards gold since the financial crisis was highlighted by a European central bank decision last week to cease an agreement to limit sales of gold. I thought it's ending sales of gold. Anything to slight gold in these articles, I thought it was ending all gold sales, as the region's institutions are no longer selling it in large volumes and are instead now net purchasers. Overall, year-on-year demand for bullion increased 8% to 1,123 tons in the second quarter, boosted by central bank purchases and investors piling into gold-backed exchange-traded funds, not counting any demand out of China. So I don't see any mention of Chinese demand there. And then they're talking about the global macro positions for gold. So, again, more good news for gold. You have these central banks, whether it's the European Central Bank, ECB, Federal Reserve, Bank of Japan, People's Bank of China. All of these guys are doing crazy monetary policy right now. And it looks like the race to debase is about to accelerate. You have people like Ray Dalio, he created and ran the world's largest hedge fund. So his comments carry a lot of weight in the professional money manager circles. So when he says to increase gold holdings, remember, a lot of professional money managers, no independent thinking or very little independent thinking. There are a lot of copycats in professional money managers. So good news, more good news for gold. Just wanted to get this story out there for you guys. And this combined with financial repression and Japanification, where the central banks, in addition to trying to devalue their currency, they're trying to eliminate interest rates because governments cannot afford interest rate payments on their debt. They need them manipulated lower because there's more debt, so they have to manipulate interest rates down. The larger and larger debt, they cannot afford higher rates. For example, Japan is in a situation now where Japan cannot even afford a 1% increase in interest rates. That is trapped. The definition of being trapped. So that is where the European Central Bank is headed. They're doing it with negative interest rates. That is where the Federal Reserve is probably headed. It seems that the people inside the Fed are a lot more amenable, including Ben Bernanke, former Fed chairman, to negative interest rates over the last couple of years than they were in the past. And all of these things, central bank purchases, devaluing currencies in the accelerated race to debase, trade wars, and artificially manipulating interest rates lower with financial repression, basically eliminating people's incomes. All these things are good for gold because then you're not getting paid income to not hold gold. So you're not getting 5% holding a very low risk bond instead of holding gold. So gold then at zero is going to look on a relative basis, holding physical gold, and currencies being devalued and gold price going higher in all these different fiat currencies. Really, the price of gold in every fiat currency has been up a lot except for the dollar, and now the dollar price in gold is finally starting to catch up. Now, obviously, it's still manipulated, and it's extremely well documented. If you don't believe that, go check out the work of GATA, Gold Antitrust Action Committee. I think they do an excellent job documenting it. Now, they've been very wrong on their price predictions. A lot of people in the gold community have. But their analysis of the actual manipulations in the market, trying to fight for more transparency by suing the Federal Reserve and lobbying the CFTC, I think they've done a good job there. But on a relative basis, gold is going to look very attractive relative to bonds, especially if you're an income investor and you're not getting income in bonds. And then in a lot of other asset classes, gold is also going to look a lot less risky, especially with the valuations we have now in stock prices. If you're buying stock prices at these valuations, unless you're a short-term trader or momentum person or you're hedged, you're pretty crazy. The stock market could go a lot higher, but it's not going to go higher on any fundamentals, despite what the talking heads on Fox Business, CNBC, and Bloomberg are saying. And they're trying to justify fundamental reasons for why the stock market could go higher. Stock market's not going higher due to fundamental reasons. Stock market's going higher due to central bank liquidity injections with quantitative easing, flight capital that has left China, the emerging markets, Europe, coming here to the U.S., and going into U.S. real estate, U.S. bonds, U.S. stocks. So to wrap things up in this, again, short little update, more good news for gold. On top of the European gold selling agreement ending, Ray Dalio's comments, just a lot of good news for gold all around. Doesn't mean we're going to see $2,000 gold in the next couple months, but the gold bull market in U.S. dollars, we're gonna have some fun over the next couple of years if you're a gold investor. Now, unfortunately, your bills are gonna go up with inflation, taxes, currency debasement. This is a new normal, whether you're in Europe or different parts of the United States. But if you are invested in, again, not financial advice, if you're invested in some physical precious metals, although I think in general, precious metals are mostly for insurance and wealth preservation. Some people consider them investments, but if you're in precious metals royalty and streaming companies or mining stocks or some junior miners, Eric Sprott has been buying a lot of junior miners. He cashed out some of his Kirkland Lake gold profits. I think he sold like 10% of his shares, and he's been diversifying that into juniors lately. He's been more aggressive. Over June and July, he put, I think, over $100 million to work into juniors and small producers. Okay, guys, well, that's it for now for the short little update.